Hi, hello, good evening, friends. Welcome one and all to Super 25 2.0, India's largest online stock traders conference. Friends, we have successfully completed 20 sessions as a part of the seminar series. We are here in the 21st session titled Empowering Your Trading with Volatility Dynamics. The speaker for today is Gunjan. Gunjan is an option trader based out of Melbourne. His trading approach is always mechanical and mathematical in nature. He manages his own fund. He is a co-founder of livetradingroom.in. He has been a trader for close to maybe Gunjan 15 years now.
20 years nearly, yeah.
Yeah, so I think you have experienced the fall of 2008 also.
Yeah, 2008. When 2001, when the 9/11 happened, just started after that. I've seen the
Okay.
upsides
So
and downsides.
did you experience that fall? Did you witness it or you were
Yeah, I was
just
trading on
after that?
that. And I was trading that day on
Sounds good.
2008. I was trading the day when Nifty made 2200 odd. So same that day as well.
Awesome. So friends, Gunjan is also a CMT and he is also a certified financial technician. Both the charters by education, he's an MBA in finance and a master of financial analysis from Latrobe. Well, Gunjan, it's a great pleasure having you on board as a speaker. And I think you are speaking with in our program for the very first time. We did plan last time due to some reasons. The plan was
Yeah,
changed, if you remember. So
yeah. This is the first time. Yeah.
it's really a great pleasure to have you on board. On behalf of all the participants today, I extend my warm welcome into the program.
Thank you, Ashok, and welcome everyone, and thanks for joining in. First of all, Ashok, this is a great initiative from Traders Gurukul and your team, and in this time where some sort of online education is very helpful, you're doing a great thing. So well done on that front, and welcome everyone. Ashok has given an overview about what I do. um, I know Shok for a few years now, and as I said, he's been doing great. And thanks for this opportunity. So my session today is about volatility. Uh, I am an options trader, and volatility is very close to my heart. And it is it it's the basic block of all my trading strategies, and as a hedge fund manager, it plays a key role in how I trade and build my portfolio. So it's a very large topic which will be hard to complete in 90 minutes or so, but I've just given I'll try to give a brief overview of how I look at things and how you should look at things, and maybe pave way for you forward to do more research. I'm open for Q&A later if we have spare time. We'll try to take as many questions. But you can always, if later on as well, if you have any questions, you can always text me, DM me on my Twitter, which will be given to you later. So without wasting much time, let's start the presentation. Uh, it's empowering your trading with volatility dynamics. So a little bit about myself. Presently, I'm a hedge fund manager based from Melbourne, Australia. Presently, I'm in India for a vacation and stuck due to COVID, but I live in Melbourne. I manage a hedge fund which I trade all the commodities and all the commodities in the US commodities, equities, volatility, instrument, cryptocurrencies. I've been part of Traders Planet. I've been extra director at My India. Uh, have been part of Market Technician Association in US, and I'm co-founder of the Multiplier Expo Analytics, which some of you might know, LTR and the SHE. My trading, as I said, is revolves around crude oil, Brent, natural gas, all the commodities, agro commodities, uh, indexes around the globe, soybean, coffee, VIX instruments. I trade Bank Nifty and Nifty as well, some of Indian stocks, a lot of crypto as well. So almost everything. main specialty, but I trade in most of the things that I trade via options, and I am a portfolio manager, which with the main focus of portfolio based on options. Many people uh, build portfolios around different assets, but my portfolio is around options. So that's what I do. I've been trading since, as I said, 2001, 2002, and been consistently trading. This is what I do for a living. And so that's about me. So tonight we'll discuss a few things. We'll discuss about option trading, how it is a modeled approach. It's not a linear kind of a structure. It's a non-linear structure based on models, and it's a modeled approach. Then we'll talk about volatility. We'll give an overview about it. We'll talk about types of volatility. We'll discuss the concept of reversion, and we'll use how to measure volatility. So most of this is of session of today is all about uh, I'll give you an ideas. This is not technical analysis where I'll give you a system and you can start trading about it tomorrow. As I said, this is an introduction to volatility and how you can use volatility as a tool in your overall trading. And in the end, when we talk about measuring volatility, I'll use ATR, and through ATR, I'll show you a few tricks of how you can measure volatilities and how can you can differentiate volatility between different assets, and then a couple of more tricks. And in the end, we'll have a Q&A session if time permits, hopefully. And so, yeah, so we'll start with option trading, a model approach. As I said, option trading, options, most of you, I believe, are options trader. So you trade either long options, short options, or maybe some strategies, or mix and match, or bits of all. I'm sure most of you know about options or trade options on a daily basis. So option is based on more different models. Most common model that you might have heard is the Black-Scholes model, but there are Cox model, there is a binomial model, and there are many other models. So option, because it's based on multiple assumptions and multiple variables, so it's not like your simple underlying asset. For example, it is not like buying an Nifty future. It's more than that, because a lot of factors have an effect on it. For example, if you buy a 15,000 Nifty future and it goes to 15,100, you get 100 points. That is 7,500 rupees, I guess. Lot say 75. But if you buy 15,000 call and Nifty goes to 15,100, you don't make 100 rupees, right? Because and that is the difference between the payoff. If you buy a Nifty future, you make 100 rupees. That's a linear payoff. If Nifty rises up 100 points, you get 100 points of profit. If, on the other hand, with options, it's a non-linear payoff. So that's why it is based on a model, and it shouldn't be traded just like any other assets. I've seen people lose a lot of money because they treat options just like they treat a future, or they treat like buying a stock. So we are, first thing is that it's a model approach, so you should look at it and you should try to first of all look at it like a different instrument. This is a famous quote by George Box in his book written in 1979, that essentially all models are wrong, but some are useful. What I mean by that? So as I said, options are based on a model approach, but then we say essentially all models are wrong, but some are useful. So when we are talking about model, that is not the holy grail thing. Models are wrong. Why? What I mean by wrong is they can never be like, if you buy 15,100 call on Nifty or 15,200 call, whatever, put or call, your model will tell you the price closest to that. Or if we are trying to measure volatility, your model will tell you the price closest to that. Sometimes you might find the exact ones, but model will come. We are trying to make models which can bring prices closer and closer to reality, but it can never be exactly the same. For example, if you want to build a model of your own house, the perfect model or the 100% correct model will be to make another house of exactly same proportion. Otherwise, it can never be same. But if you make a small model, it can give you a rough idea of, if you go to an architect and he makes a model of your house, of your dreams that you want to build on eventually, then he is giving you a rough idea how it will look like when he will build up, when that house will be built. It that will be the real thing. But so all models are wrong. By wrong, I mean they can never be the exact ones, but some are useful in the sense that they are useful to bring us closer to the fair value or theoretical value. I'll talk about theoretical value in the next few slides. So if you want to find the fair value or the theoretical value of an option, the best models will bring you close to that. But if you are expecting it to be 100% correct, it can never be. It's just like you might have heard people saying that my strategy works 99.9% of the times. That is, they are saying that they make money out of 1,000 times. They are making money 999 times out of 1,000. That is what they mean by a perfect model. But actually, that is not like that. If you are a trader, most models make 50 to 60% of the time, 70% of the time they are right. Rest, it's all about the risk management. If you do that correctly, you make money. So we start with this quote: essentially all models are wrong, but some are useful. And options is a modeled approach, but the models that we'll be using we are trying to bring that as close to the price as we can, or we are trying to get the best idea or the closest idea, but that can never be the idea that is the reality. So a little bit of theory, let's discuss this. You might have heard about Black-Scholes model. If you haven't heard it, I'll give you a brief overview. You can, after the event, you can look into it of the Black-Scholes model. But this is the prime model, the premier model that is still since 1969-70 till now. This is the model. We have made some changes. Some people have made some changes in these models to make it better, but the basic model remains the same. So since 1969, this is the model which is most widely used. As I said, there are more models like Cox model, binomials, some models, Hespen model, for which we use for interest rates and other things. But for option prices of stocks, commodities, and major assets that we use, you guys or we use, Black-Scholes is the most widely accepted model. So I'll read it for you, then we'll discuss about it, and then I'll explain this this formula as well. That if you can see my cursor, this is not difficult. Again, we'll not go into the maths of it, but I'll just try to tell you what it actually means. We are not going into hardcore maths into this session because not the time for that. But I'll try to make it simple for you, so you can at least you have a rough idea of what they are trying to say, of what this model was for actually why this was built on, and what if this is a Nobel Prize winning model, why did it win the Nobel Prize? Let's discuss it before starting on. So I'll read it for you, then we'll discuss. So how traders use models. Several elements contribute to the value and option. As I said, there are multiple variables that contribute in finding out the value of an option. It took academics many years to figure out exactly what those elements are or were. Fisher Black and Myron Scholes together pioneered research in this area at the University of Chicago. Ultimately, this work led to the Nobel Prize for Myron Scholes. Fisher Black died before he could be honored. So before the Black-Scholes model, options used to be traded, but they never knew what was the real actual price. What is the fair value of an option? We had no structure to understand what the real price of a call or a put should be. Think about a time when you are trading an option, but you don't know the fair value. It's just the demand and supply. So we don't know the fair value. But what this Black-Scholes model did is to bring out a formula that can help you bringing closer to that price. So as I said, these models are usually we started essentially all models are wrong, but some are useful. So this model is a useful model, especially at the time when there was no other way of finding out what the fair value of an option is. So second paragraph, the Black-Scholes model values European call options. At that time, there were only European call options on non-dividend paying stocks